All right, welcome back. It looks like it's 10 a.m. Let's get started. Today, I am going to get into the Connect homework with everybody and to walk you through how to work some of these adjustments. And remember, the ones that I showed you on Monday, there's basically three types. We're going to be doing adjustments on supplies, the prepaid items where there's like prepaid rent or prepaid insurance, and then of course the other one, which is going to be the adjustment on equipment. So in a moment, I'm going to bring up the Connect homework. We're going to do a couple of problems today. And then again, as I go through some of these, let me know if you have any questions. It went really well with my Monday night class this week. I showed them a bunch of stuff. So I'm going to do a lot of the same things with you that I did with my Monday night class. I'm going to bring up my template. And I'm actually going to take at least one or two of the problems. I'm going to take them a little bit farther in terms of showing you everything about the adjustment and the effects on the ledger as well. So having said that, any questions before I get started? I'm just waiting a minute. I know it's 10:01. I've got 4 people in here with me today. Usually once I get started, more people log in. But does anybody that's in here right now have any questions before I share my screen? And if not, that's fine. Let me do that then. So let me bring up. All right, so this is going to be in the Chapter 5 homework, and I'm going to go ahead and get into the student view because this is how you will all see it when you do work with the problems. So let me minimize my view here just for a second. All right, so Chapter 5 homework. I'm going to click Begin. And again, I'm going to be on problem number 1. Again, let me know if you can't see it. Again, it should say problem 1. This is Chapter 5 homework. They walk you through 3 different types of adjustments. Now, remember, the thing about adjustments, we're still working in the journal and we're still posting to Ledger just like we did in Chapter 4. It's just that remember the idea here is that we have to do adjustments for the financial statements. It's all about that time period idea. So I'll just start here with number 1. And then when I do this, I'm going to go a little bit back and forth with my screens because I want to go into the ledger. This problem only does the journal, and I want to show you the ledger as well. So in looking at this problem, again, we'll look at number 1. Again, watch the dates. And notice it says on June 1st, the Contra company, they paid $16,800 rent in advance. And again, this is for a 7-month period. It says the $16,800 was debited to the prepaid rent account. So this is the first idea right here. Now, the requirements of this problem is to prepare end of June adjusting entries for the company. So this would be, if you can imagine, the Contra company is going to prepare a financial statement or income statement and balance sheet for the month of June. And we want to make sure that this prepaid rent, which is an asset, that we account for the expense part of that asset, which is rent expense. So keep in mind, it's a 7-month period. Again, that's the total cost. So let me go to my other screen. So 16.8. So this is what I'm going to show you. So let's say, I'm going to make sure I got the right screen up. All right. So if we were in our journal, I'm going to go ahead and type this in. So let's say we've got June 1st. We would say prepaid rent. We're going to debit that. And then let's just go ahead and credit cash. And again, that's going to be for the $16,800. So at this point, this is something that you would have done even in Chapter 4. So this is how you do your original journal entry. Now, of course, when you go to post it, you go to your ledger. And of course, I'm using the T account visual for our ledger. So we put that $16,800 as a debit to prepaid rent and a $16,800 credit to cash. So at this point, nothing's really new because I'm just showing you the journal ledger aspect of it. So this is our journal entry. There's our journal. That's the detail. That's the record. And then we post it to our ledger. There's the credit to cash and of course the debit to prepaid rent. Now assume we are at the end of the month. We're on June 30th. And so we want to figure out, I'm going to go back to the screen to show you, make sure you got the problem now. It's that again, it's a 7-month prepayment. We paid rent 7 months in advance. So what we want to do is we want to take that 16,800 and essentially divide it among the 7 months. Each month essentially is going to represent our rent expense. So just on your calculator, and I'll do it too, just take, again, the 16,800 divide by 7, and you're going to get $2,400. Again, let me write this out so you got the visual of what I just did as I'm talking, because I just type it into my calculator. But again, all you do, let me get my stylus is a little crazy. All right, so again, I would take the 16,800 divide by 7 months. So essentially $2,400 is our rent expense per month. That's our monthly rent. So what we'd have to do is to do the end of month adjustment. And again, remember, I'm doing this in the journal first, and later on today I'm going to show you how they want you to put it in the worksheet. But so we go to our journal, and let's say I'm going to type in here June 30th. That's going to be the debit. And then I'm going to type in prepaid rent. That's going to be the credit for $2,400. So that would be your adjusting entry. That's the entry that they would want you to enter into Connect. So then when you post this to your ledger, of course, you'd have rent expense of $2,400 debit, and then prepaid rent would get a credit of $2,400. Now, with the prepaid rent account, I just want to show you this. After you post it, the balance in prepaid rent would then be $14,400. That is what's left of our prepayment. Okay. And so again, when you are in the problem, when you're in Connect, what you'll do is they give you the general journal. You'll click the cell. You're going to look for rent expense, which these again are not in any type of order. There it is, rent expense, debit $2,400. There's your debit, and then I'm going to look for again the prepaid rent, which should come up. There it is. Hit the credit, and then remember, when you guys go to do this in your homework, you still have to hit record entry. So when I hit record entry, it does it, and then of course it's going to look like that. Okay, so again, all they're focusing on here is just the journal entry, which is important, but I also want to show you the impact that would have on your ledger as well. And remember, let me go back to my other screen. So,
can I ask you a question?
Yes, go ahead.
So we're gonna have to go through all those steps in order to get the answer?
Yes, you should.
Okay.
And the actual answer is, let me go back. Again, I'm going to go back to the Connect. This is the actual answer on this problem. This is what they would want you to enter as your official answer. The only thing
we would have to go do the Excel first. We would have to work it out on the Excel sheet to find in order to find out the answer.
No, you don't. I'm using Excel as my platform because I think it's easier for me to type it in, because sometimes when I write it in on my stylus, it doesn't come. I don't think it comes across as clear. And sometimes maybe somebody can't read my handwriting. So I'm just using
the Excel is just an example for us right now.
Yes.
Okay, gotcha.
I'm just showing you my goal here. Yeah, let me go back. Yeah, I don't expect you guys are not required to use Excel. I'm just using this. Yeah, I'm just using this to try to give you a visualization and saying that this is what would have created the event to have the adjustment, because they bought the rent. And then this would be the actual adjustment. You'll actually enter all of this into Connect. Okay. But again, I just think it's helpful just to kind of I'm just trying to make sure I reinforce the general journal is where we record, and the ledger is where we post. And the ledger is just going to summarize each one of our accounts. Okay. It's a good question. And the other thing that I'm trying to lead into with this format is that I believe I said this on Monday, is that eventually we are going to prepare financial statements. And the financial statements are prepared from the ledger. All the numbers are pulled from the ledger. And so it's important that we have to update all of the accounts before we get to the financial statements, or the financial statements will not be correct. Okay. All right. Let me go back. So that was the first one. So let's do the second one. So let me get back to the connect problem. And this is number 2. All right. So number 2 again, and I'm just trying to emphasize, guys, watch your dates on this. So this says on June 1st, so that's our start. It says they bought supplies, which is $12,580. They debited the supplies account. Of course, they probably credited cash or accounts payable. Again, I'll put that up in a minute. But that's the entry that creates the possibility we have to make adjustments. It says an inventory of supplies at the end of June showed that $9,275 were on hand. That means that's what's left. So a couple things first is let's go and do the record. And so let's assume we bought the supplies. And so again, I'm just going to use this same area in the journal. So if this is June 1st and we bought supplies, we would debit supplies, and let's just say we credit cash. So supplies, and the amount is $12,580 debit, and then $12,580 credit. Again, this is something that you would have just done in Chapter 4. You would have entered it into the Connect homework, something very similar to this. And then if we go ahead and then post, supplies gets a posting of $12,580 debit, and of course we'll just debit or credit cash $12,580. So again, that's the beginning. That's not what they're asking you to do in this particular problem, but I'm just trying to show you this. Essentially, if you were running a business, you would have to go through all these steps. Now, we're at June 30th, and this is where the answer comes in, is you need to figure out for the month of June, again, they're going to prepare financial statements, how much supplies did they use? And so off to the side here, if they've got $12,580, enlarge that so you guys can see that a little bit better. So if you got $12,580 of supplies, and the problem says there's $9,275 worth of supplies left, that means that the difference between these two had to have been what they used, which is $3,305 worth of supplies used. And I'll get back to this in a minute. It's something I want to talk about. But again, so if they used $3,305 of supplies, that's going to be what we want to expense. So what we would do then is we would have debit to supplies expense and credit to supplies for $3,305. Okay, so this right here, let me just kind of highlight this in Excel. That would be the actual adjusting entry that they're going to want you to enter into the Connect assignment. I'll do that in a moment. But again, before I do that, one thing I just want to comment on, when they say, and again, I'll share the screen again so you see what I'm reading. When they say in the problem, an inventory of supplies at the end, and some people may not know what that means. What they're telling you they did here is somebody had to count the inventory. Somebody had to take a physical count, go to the supply room or whatever, and take their clipboard and do some counting and figure out how much such supplies is left at the end of June. Somebody's got to do that. Once they've done that, that's where they came up with this amount that's $9,275. And they call that, in business, that's the concept of what they call taking a physical inventory or counting inventory, which is a very important function of accounting. And again, I don't know if some of you've ever had to do this, but if you've maybe witnessed people at stores, if you've ever been out shopping, where you looks like employees are counting, where they got clipboards, or I've seen this at the grocery store, like at Schnucks or Walmart, where sometimes they're in the cold food section, and I see these people wearing these gloves because it gets pretty cold when they're opening up the door. They got these clipboards, or they got these little machines where there's kind of scanning items. Now it's kind of like you can count by barcode, but they're taking an inventory so they can figure out what they got left and also what they've used. And later on in accounting, they're going to talk about these different types that they call these inventory formulas on how to determine what you use, which is very simple. It's just you have to use some basic math. In this case, all we did was we subtracted. But I just want to emphasize that it's not to get away from this problem. Counting is actually taking a physical inventory is a pretty important concept because again it has impacts on the financial statements, and it also could lead to other things. Like you could even detect if somebody's stealing from the company, because sometimes you take physicals, you know what your sales are, you know what your inventory should be, and sometimes you keep looking at the numbers, and if this doesn't make sense, this could be a situation where you determine that the supplies usage is way too high based on your volume of sales, for example. And we had a problem with this in industry years ago. I'm sure they still have it, the same type of problem, is with workers taking company supplies home, like paper and pencils and stuff for their kids. And they used to say, like in the month of July and August, that's usually when you go back to school time, that companies like Office Supplies and Staples and Office Max and so forth, that was typically their biggest orders from companies as well, because companies were getting low on supplies. And so the way a lot of companies deal with that is they then put more control on when you request supplies. You have to actually fill out forms. Now, we used to have deals where you could just literally go to the cabinet, and they had brand new pens, nice Kleenex boxes, and people would literally just take them and put them in their cars. And you might think, well, that's petty, but that adds up, and technically that's still company policy. And every company may have a different rule in terms of, they may say that's okay to do, but at the end of the day, and I've talked to some people who work at some of these other companies, I asked them how do they do their supplies, and most of them these days is that you have to put an order in, a requisition to your supervisor, just to get a new pencil. So companies really watch their bottom line in terms of their cost. But so in this problem, so we've got the entry, and then let me make sure we post it. So once you got it, you would then post it to your ledger. So supplies expense would get 3305 debit, and then supplies would get 3305 credit. And again, you would update your ledger account of supplies just to show you that your balance should be 9,275. So right there, that is what your supplies and supplies expense accounts would look like after you did the adjusting entry and then posted it to the ledger. So if you were getting ready now to prepare a financial statement, like an income statement, that supplies expense would now be posted, and once you prepared the income statement, it would show up on the income statement. Now, let me go back. So again, if you are in Connect, again, what they want you to do is go to that cell, click the drop down there. Like I said, you don't have to use Excel. They've got their ledger set up like this, or their journal set up like this. So I'm looking for supplies expense, which is right there. You would debit it, and then I would credit supplies, which I think they had it right next to it right there. There's the credit, that, and then don't forget to hit record entry. And then at this point, I've entered 2 of the adjusting entries. And these are the 2 different types. They're 2 of the 3 different types they're having you do in Chapter 5. Later on, we'll do more types of adjustments. They typically call these type of adjustments the prepaid adjustments. Supplies, prepaid, equipment are all in that category. But we're just dealing with expense adjustments in Chapter 5. We're not dealing with revenue adjustments. We'll do that when we get to Chapter 12. But let me pause for a moment. Are there any questions on any of these 2 entries that I just put? The equipment in a minute. But any questions on the equipment expense or even the supplies expense adjustment? This is the journal entry. This is what it would look like.
You're breaking up.
One thing about this is I know that as I'm recording this, you should get a good recording of audio, because I know my audio is working when I'm recording it on my computer. If it's not coming in clear, I got a couple other people home on the computer right now, so I think it could be an internet. It could be just a traffic on the band. on the Wi-Fi. But on a Monday, nobody else was on the internet, just me. So, but let me know if you can't follow this, or if I need to change something. I'll try to do it again in a minute. But am I still breaking up? Any better? I'm just adjusting a couple things on my computer to see if that helps. Sometimes if I speak closer to the microphone, it works better. Okay, so that's the two entries. That's the first two on this particular problem. So let me go back to the transaction list. Let me get back to the connect, and let's look at the third type. And the third one is going to be the depreciation adjustment. So this is number 3. And it says on June 1st, they bought equipment that cost $108,000. It says the equipment has an expected useful life of 9 years and no salvage value. The firm will use the straight line method of depreciation. So first of all, let's deal with this thing called equipment. We all know at this point that that is an asset. And anytime you buy equipment, you would debit the equipment account and credit either cash or accounts payable. So let's start the entry. And let's say, again, we bought the equipment. And this is June 1st. So here's what would happen. You would debit equipment, credit cash for $108,000. And again, that's again what the journal would record. So that's your start. Now, here's the issue. Remember, when you buy equipment, in this particular problem, this business is expecting to use this equipment over the next 9 years. Again, that's just an estimate, but that's the numbers we have to deal with. So what we're going to do here is we're going to take that $108,000 of equipment purchase, this $108,000. Technically, guys, that's actually a prepaid expense. Even though we're putting this as an asset account, that's actually what they would call a deferred expense or prepaid, because we haven't expensed anything yet. We're putting it on the balance sheet. So what we're going to figure out is how much of this $108,000 are we going to allocate to expense for the month of June. And in the accounting world, we call that depreciation. And I believe I talked a little bit about this on Monday, and I'll mention it again. Remember, depreciation is not about value in the accounting world. Okay. Outside of accounting, a lot of you might view depreciation as a inflated value. Like, for example, with an automobile, you bought a car, 10 years later, it's worth less, and they say, well, it's depreciated. And that's a common definition outside of accounting. Accounting uses depreciation as an allocation method. So I would rather you view it as, for this class, we're allocating cost. We're not doing anything with the value. Okay. So the way we do it, and again, I'll go back to the formula in a minute, is the formula is that straight line method formula. I had my mouse upside down on my stylus. So the way we do it is you take the cost. I got the right screen on here. Come on. This one. Right. So again, you take the cost, subtract out what's called the salvage value, and then you would divide that by the estimated life of the asset. Now, in this problem, the estimated life, they stated in terms of years. Okay. For this problem, we only want 1 month. We want 1 month of allocation. So in your straight line formula, the cost here is $108,000 minus 0, because they said salvage value, remember, is the expected value when you're done with the equipment. They said 0, so that's pretty easy, just minus 0. And then we have to divide by something. Now, I would suggest that most of these problems that you're going to encounter in chapter 5, typically they do it monthly. So let's divide by the number of months, not by the number of years. So if you got 9 years and there's 12 months in a year, that would give you 108 months. So again, I just to take 9 times 12. That just means that there's 108 months here. Just take 108,000 and divide by 108. And if you do that, you're going to get $1,000 per month. Okay. So what I'm saying is that $1,000 is how much you're going to allocate to expense for the month of June. Okay. So if we did that, you would then go to your adjusting entry. Let me get to my screen in a minute. Go back to the other screen. So we would say adjusting entry, depreciation expense debit, and then we're going to credit accumulated depreciation, $4,000. So there's several things I want to talk about these two entries I just showed you. First up is look at the adjusting entry. It's debit, depreciation expense, which I think that's pretty logical. Notice we do not use equipment expense. It's called depreciation expense. That's the debit. Notice the credit. We do not credit equipment. The credit goes to this account called accumulated depreciation. And go back and watch the video textbook, but that's called a Contra asset. Accumulated depreciation is an asset with a credit balance, believe it or not. So what happens is this account is used in your ledger to keep track of all the amounts that you depreciated every month, every year. It's called an accumulated number. That's why it's called accumulated. But it just keeps track of all your allocations. Notice the equipment account. Let me go back and let's post this. I forgot to post. The equipment account, when you posted that purchase of $108,000, that number is not going to change. That's your cost. That's your original cost. That's what they call historical cost. So you're never going to mess with that. The depreciation expense gets 1,000 debit, and accumulated depreciation gets 1,000 credit. So the accumulated depreciation, we did not see this account in Chapter 4. This is a brand new account concept in Chapter 5. It's used with the adjusting entries. Contra asset, credit balance, studied a little bit. But every time you do the equipment adjustment for adjustments, it's debit depreciation expense, credit accumulated depreciation. You post it, and then in your ledger, notice the equipment account. You don't mess with that. That stays the same. So the allocation goes to depreciation expense and credit accumulated depreciation. And I've seen this in the past where students would try to record this entry by crediting the equipment account, because that's how we would credit the supplies account when we did supplies adjustments. Equipment's different. Equipment, typically you're going to find when you take more accounting, it's put into this category of what they call a long-term, long-lived asset, where typically you use it more than a year. And they deal with it a little bit differently than
I didn't even know you had a dentist appointment today.
With some of these shorter term type of assets. Let me check something on my screen. Right, does anybody have any questions just on this adjusting entry for equipment? One more thing I want to show you on this, but just in terms of what you have to actually enter. You have to enter debit depreciation expense for 1,000, credit accumulated depreciation for 1,000, and then that would be the answer you'd want to put in the connect. Okay. Notice the time period. Can you guys still hear me? Can anybody hear me? Am I breaking up? Taylor?
Yeah, I
Can you
couldn't hear you at all.
Yeah.
Yeah, it's just breaking up a little bit.
Okay, I apologize. But once this session is over, and we got about another 20 minutes in it, everything that I'm recording, you guys can always go back and play it in Blackboard. I'll get this thing posted in Blackboard, and you'll be able to hear all the sound if you can't hear it on your phone or on your computer right now. But,
Okay.
So not that that's that's the best I can handle. But so you're not going to lose anything, but yeah, you'll have to go back and later and look at it as you practice some of this if you have some questions. And again, I'm not quite sure why, sometimes it just could be an internet issue or connectivity issue. Sometimes it happens. I didn't have any problems on Monday, but today it seems like maybe there's more people on. Who knows? All right. Well, let me go back real quick. So let's say I'm in the Connect assignment. Let's find the account. You'd say depreciation expense, debit 1,000, and then let's credit accumulated depreciation equipment 1,000. That, and then you would hit record entry, and then that's basically it on this particular problem. That's all you have to do in this problem. All right. Now, I want to show you one more thing which I feel is really important, and again, that relates to the equipment. So if you can look on my ledger, what I've set up over here, it's off to the side. You'll notice we've got equipment, which is 108,000, and accumulated depreciation, which is 1,000. So there's a concept, if you watch in the PowerPoint and read the book, there's a concept that they do call book value that relates to the equipment. And what that is that's just the presentation on the balance sheet. So what's going to happen is, on your equipment account, which has 108,000, which represents, again, the cost, then you'd say $1,000. I'm going to put this in as a minus 1,000. Let me put that there. That represents a contra asset. I put that in as a negative just to show you that you're going to actually reduce what's called the book value. The book value is when you take 108,000 and you subtract out 1,000. So 107,000 represents, in accounting terms, what they call a book value. It has nothing to do with market value. It does not mean that the company can now sell that equipment to the public for, or somebody outside the company for $107,000. That's not what it means. It means that the 107,000 represents how much is left to allocate to expense. So we've already, from 108,000, we just took 1,000 of it and expensed it because you used the equipment. You're assuming that you use the equipment for the month of June. Once you use that, we're saying that 107,000 is how much is left to depreciate over the next 9 years and 11 months. That's the rest of the life of the asset. Okay, so again, so you got the cost of the equipment, you subtract out the accumulated depreciation, and then you get this thing called the book value. That could come up on a quiz or even exam questions. They tend to ask that kind of stuff. So it's not difficult. You just got to make sure you know what it represents. And the math, again, is pretty easy. You just take the cost minus any accumulated depreciation. Okay. Does anybody have any questions on just that concept of book value? And I know for some of you, my volume might be kind of strange right now, but there's nothing I can do right now about that. I'm trying to make sure I speak clearly so that as I'm recording this, you will all be able to go back and watch this again in pieces if you need to, as you're practicing the homework. But does anybody have any questions on anything related to the equipment that I just showed you? Equipment, accumulated depreciation, or even that concept of book value. All right, well, one more thing I just want to mention on this, because we talked about this on Monday, is that, so straight line method of depreciation means that every month gets allocated the same amount. It's a fixed number. So when we did that 108,000 divided by 108 months, we get 1,000. That means every month our adjusting entry for equipment will be the same. So this amount right here, this account, depreciation expense, accumulated depreciation, this entry right here will be the exact same entry at the end of July, at the end of August, at the end of September, and so forth. Every month, you're going to have the same entry that's recorded. And, most of this stuff is automated. Typically, you know, in your accounting system records a purchase of equipment that needs depreciated, usually there's software that's going to calculate it for you. And then once they do that, they're going to generate these journal entries automatically. We often call these type of entries recurring entries, and they were just automatically input into our journal and posted to our ledger. Nobody's actually physically doing what I'm showing you right now. Again, we're just doing this for learning purposes so that you see the concept. So the question came up is, so what would happen at the end of July? Let me go one step farther. So let's say we were into the end of July and we got to July 31st and we did another adjusting entry. It'd be the exact same thing. Let me copy this down. We'd still debit depreciation expense. We would credit accumulated depreciation for 1,000. Notice that would be the same. And then what I want to show you here is what would happen to that book value. So notice we don't post to the equipment. You have another $1,000 posted to depreciation expense and another $1,000 posted to accumulated depreciation. And at that point, your accumulated depreciation would be at $2,000. So what would that do to your book value is your book value would now be at $106,000. Okay, so it's a pretty easy amount to calculate. You just make sure that every time that you depreciate the equipment, in this case, every month, that book value would go down by 1,000 because the accumulated depreciation is going up by 1,000. So notice accumulated depreciation, as it continues to increase, this book value will continue to decrease. And ultimately what would happen is if you depreciated this equipment over 9 years, and that's it, eventually that book value would go to zero because this accumulated depreciation would at some point in time equal the cost, and you would get 108 minus 108, and then you'd be done with the equipment. I mean, that's theory. I can tell you in reality that doesn't always happen that way, because lots of times the equipment is either scrapped before the 9 years, or in some cases it's actually can be used more than 9 years, and those are other issues to deal with. But at this point, the theory is that as you depreciate it, the idea is that you'd want that book value eventually to go down to zero, or usually they say that you want the book value to equal the salvage value at the end of the life. And in this problem, the salvage value was zero. Okay, so that's just a little bit of overview in terms of big picture, just trying to explain to you exactly how it all impacts everything and why we're doing it. So if at this point,
So the accumulated depreciation, where you got the 2,000 from, is from the June 30th and July 31st.
correct.
Did you have to put the parentheses to make sure it was credited?
Yeah, I put it in there just to show you that, just to try to emphasize that we're deducting it. Mm-hmm.
Okay.
And just for illustrative purposes here, so if this was July and we went to, let's say, August, let me just type in, let's say we were doing this for the month of August, it'd be the exact same entry. So notice I just showed you all, this is June, this is July, this is August. Every month it's going to be the exact same. And then every month, once you post, your accumulated depreciation will keep on increasing, because that's what it does. It's what they call a permanent account on the balance sheet. That's what it keeps track of. So rather than reducing the equipment account, what the accounting body came up with is they use this account called accumulated depreciation. So I just wanted to spend a little more time on this one today, because I know that's a brand new account that we have not seen yet. Okay. And so again, this book value, that's a term you need to know. And again, I'm just trying to emphasize we're still doing journal. It's posted to the ledger. None of that is changing. Okay. All right. So anything else? Any other thoughts? I want to get to at least a couple more. I want to try to show you guys the worksheet today too, to show you how that works. But does anybody have anything else that they have a question about?
It just would have by you adding the other month, it would just, instead of being 2,000, it would have been 3. So the more ledgers you have, the higher the depreciation, right?
The higher the accumulated depreciation.
I mean, yeah.
Yep. So eventually what will happen is, you see how as we keep going, the accumulated depreciation keeps on increasing. And eventually, make sure I got the right screen. Eventually, that book value would go down to 0. So this accumulated depreciation, notice every month it's going to keep increasing, and then this book value will keep decreasing, because the relationship is you take the cost and you subtract out the accumulated depreciation to get to what they call book value. Okay. All right. Now I know I went way more on this problem than what the Connect problem did, but I think for learning purposes, I think it's good to do that every now and then. Not just to do the adjusting entry, but I think you should find it hopefully helpful to also understand how this impacts the ledger and also how it could impact your financial statements. So one more thing. So notice, I'll just look at this first thing. Notice where we debited rent expense and credited prepaid rent for $2,400. That was on the journal. That was our adjusting entry. The other thing that might come up in terms of like test questions or quiz questions is what if we did not record these adjusting entries? So remember the impact. Rent expense goes on the income statement. Prepaid rent is on the balance sheet. So if we don't record these and post these, our income statement would not include rent expense, and it needs to. Our income statement would be wrong. It would be off by $2,400 in terms of profit just because we didn't record this entry. And the same thing with prepaid rent. Our balance sheet asset account would be wrong by $2,400 because we didn't post it. So I'm just trying to get you guys to think if we have to do these, and also what would happen if we fail to do these, that your financial statements are impacted. So that's, to me, that's pretty important stuff. And this happens a lot, whether it's intentional or unintentional. I've seen it where sometimes internal audit will come in and check out accounts, or you get audited from a third-party CPA firm, and they may say, well, where are your adjustments? And if you didn't do them, that could be a problem because all this is GAAP. All this is required by generally accepted accounting principles. Okay. All right. Now, I think that's it on problem 1. Problem 2, on this one, I'm looking at my time. I want to get to the worksheet today. Let me just do one of these with you guys. So on this one, they only give you 2 entries. Let's just do one of them. It says a firm purchased a 3-year insurance policy for $27,000. Notice the date, July 1st. The $27,000 was debited to prepaid insurance. Okay. They want you to do the end of month adjusting entries for the above situation. So again, 1 month is what they want. They bought this policy for $27,000. They debited prepaid insurance. So if we were in our journal, and I'll do this real quick. So let me get this in here. So this would have been for the month of July 1st. Paid insurance. Say cash. Debit that. Says that this is 3 years, and we want 1 month. So does it make sense to everybody if we wanted to convert this 27,000 into 1 month of adjustment, that rather than divide by 3, because that would tell you per year, there's 12 months in a year, so we would divide by 36, right? So if we took 27,000, divide that by 36 months, that would give you your, and you get what, 750? Yeah. Mm-hmm. So that would give you 750. That would essentially be your monthly insurance expense. So again, what you do then, and we go back to my template. So you'd say for the end of July, you'd say insurance expense, prepaid insurance for $750.
But can you tell me why you said 36 months and then say, oh,
3
because
years.
3 years?
Yeah,
Okay.
yeah. Because let me go back, because we have to look at they call it time period assumptions. And if this problem had said prepare the year end adjustment and you wanted a whole year, you could just take 27,000 and divide by 3. But they wanted you to break up this amount by month, not by year.
Right.
So,
Okay.
so since it's 3 years, just take 3 times 12 and divide by 36. Okay. And then of course you'd have to go down to your entry here in your journal. And this again is in the, make sure I got the right screen pulled up. Yeah, I got it. You debit find your insurance expense debit right there, and then find the prepaid insurance right there, and then just put 750 debit and 750 credit, and then go, of course, hit record entry. Okay. All right, and then second one, I'm gonna let you guys, and again, I've already illustrated I actually already have all this stuff recorded in Blackboard. Just if you go to the Blackboard Learning Module Chapter 5 homework, I've actually already commented on all these. So I'm gonna let you guys do the rest on this one. I wanna make sure, I'm trying to show you a little bit of a worksheet today. So let me go to the next one. This is number 3. Now, here's the deal about worksheets, okay? I do not test on worksheets. You'll never see a test question or a quiz question from me on a worksheet, but they use worksheets to help you get to the financial statements, all right? And so you typically don't use worksheets in the business world, but for this class and for this learning purposes only, I want to show you how you have to use this thing to get to the final answer. So remember, the worksheet is not a financial statement. It's just, they're calling it a tool that you use to do your adjustments. So you'll notice the way the worksheets look like is they typically start with a trial balance column. You got debits and credits. Then you've got a column here for adjustments. Notice debits and credits. And then of course they've got an adjusted trial balance. So what you have to do in this problem, they've already given you some initial accounts and their balances. And they always tell you that assume that every account has the normal debit or credit balance. That means the increase side that you learned in Chapter 3. So the first thing you'd have to do in this problem is simply just enter these amounts. So I go down here, cash, you'd enter 63,000 as a debit. Notice I put that on the debit balance because it's an asset. Accounts receivable would be 22.5. Enter that. Supplies is 9,000. And you've got prepaid insurance, which is 8,200. Notice again, I'm putting it on the debit side. Whoops, I don't know why I did that. 8,200. Notice equipment is 91,500. Debit. There's nothing in accumulated depreciation. Then we got accounts payable, which is 16,700. Notice this on the credit. Capital is 81,950. Credit. Fees income is 117,000 credit. And then the rest of them, you got rent expense, which is 10,600. Debit. And then salaries expense, which is 10,850. And then everything else, I think that's it. I just want you to see this is all the data they've given you the problem, but you still have to know which column to put them in. And this is based on what we learned before. Where should the balance be on the appropriate side? Notice debits equal your credits, 215, 650. So once you enter this for your trial balance, then they want you to put your adjustments into these columns. So they don't actually have you do the journal entries in this problem. They're just having you input the adjustment into this column to show you how the worksheet works. So on this one, I'm going to watch my time. Let's just show you one of them. They tell you that supplies used during January was 5,700. Well, that's your expense. That would be your adjustment. You would debit supplies expense, credit supplies. That would be what you would do. In this problem, you're not going to write out the journal entry. They just want you to put it in the appropriate debit or credit column. So we'll take that 5,700. We'll find supplies expense. Type it in. There's your debit. And then find supplies. Type in the credit of 5,700. And that's how they want you to enter it into the worksheet. That's it. And of course, you'd have to do the same thing for parts B and C. But because I know I'm going to run out of time here, but so here's what you do next is once you enter these three adjustments, then you do an adjusted trial balance. At that point, you would just take these same balances plus or minus anything we had to adjust and then enter the new balance into this adjusted trial balance column. So when you get to that part, you'd have cash, of course, would be 63,000. You'd have accounts receivable, 22.5. But when you got to the supplies, you would have to take the 9,000 and subtract out the 5,700. And of course, that's going to give you what 3,300 is what you would put for the supplies balance. Okay, so I just want to make sure I show you this today so you see that you have the 9,000, subtract out the 5,700, and then you update that new balance and you put that into your adjusted trial balance column. And you'll do that for all these. You'd have two more adjustments you'd have to enter. You got expired insurance, that'd be your insurance expense. And then notice that they don't make you calculate the straight line method. They just give you the answer. You just have to enter this into the appropriate adjustment column. Okay, so we're going to work more on this, on Monday too. But I just wanted to give you a heads up. You're going to see this worksheet come up in some of your problems, and you might want to say, well, how do I deal with that? So I just wanted to give you a live demonstration in terms of what you're going to have to do when you get to this worksheet. And if there's any issues by Monday, I'm hoping you'll let me know, and we can go back over some more of these types of problems on Monday. And I'm just kind of, looking at my time, and I'm already 1 minute over. But just remember that all these answers, I've already recorded all the stuff way ahead of time. This is already in Blackboard. Just go to the learning module, look up the homework video in chapter 5. And if you get stuck as you're starting to practice these. So where you should all be at, let's say by Monday, is you should be into chapter 5. You should be starting to work on your chapter 5 assignments. The due date will not be till October 25th, so you got another week or so to work on it. My intent would be hopefully to finish up most of this chapter on Monday. We'll see, again, we'll see where you're at. I'll do some more problems, and then let me know, on Monday where your issues are, what your questions are. Okay. Any questions as I wrap this up today?
Yes.
Yeah.
Oh,
With the learning modules,
Go ahead.
with the learning modules, as we go back and look and oversee what we went through Monday and today, will it have you breaking up or your voice going in and out, or will we be able to hear it clear?
It should be clear.
Okay.
In fact, even this video that I'm recording this session right now. It should come across clear because I'm recording it on my computer.
Okay.
So this video I'm gonna post. It'll take me probably about 10 minutes. I'll put it up in Blackboard, and you guys can go back and watch it anytime this week. Yeah, I mean, I do apologize. That's the negative thing about technology, is when you have breakup issues. And I don't have it all the time. Sometimes, my Monday night, everything on Monday went pretty good. And just that today something's crazy. Maybe it's because Microsoft did an update last night. Maybe that's part of it. I don't know. So, but by Monday at our next session, we should be deep into chapter 5, if not being able to finish it. But start to practice these problems in Connect. Watch my videos in Blackboard. And then in the meantime, email me if you have questions. And then when we come back on Monday, we'll see where everybody's at. Okay? All right, any final thoughts before I wrap this up?
The accumulated depreciation and the depreciation expense. Could you just tell me one more time the difference?
Okay, so
And will they both be credited?
no. So the accumulated. Let me go back to the previous problem. Hold on, because we already have that answer input. So let me get this up. All
I
right,
was driving. I'm sorry, I couldn't pay attention.
The depreciation expense is just the expense account. The accumulated depreciation is an asset account. So this, when you guys see the accumulated depreciation, think of they call it a contra asset, but it's an asset account on the balance sheet with a credit balance. Okay, and then as you go and then review the PowerPoint, I think I got some illustrations on this one in the PowerPoint video. And watch this, of course, watch this discussion again later this week, once I get it posted on Blackboard. But go back and study this. It's an important concept. But accumulated depreciation is an asset with a credit balance. It's different. Okay. All right, was there anything else? I know some people may need to leave, but they got a class and need to go, but I can hang on here and answer any other questions. Anything else with today or in terms of where you should be at hopefully by Monday at our next meeting? I guess that would be, gosh, is that already the 19th next Monday? It's crazy. Yeah, so we'll be well into October at this point next week, but yeah, I would anticipate getting through most of chapter 5 by Monday, but again, we'll see where everybody's at with the adjustments. So, all right, anything else from anybody? All right, well, let me wrap this up. I'll go ahead and get this thing recorded. I'll get this posted in Blackboard. Usually takes about 5-10 minutes, and then you can go back into the Zoom recordings and watch them. And then if there's nothing else, we'll see everybody then on next Wednesday. Okay, all right, guys, have a good one.